Good morning. Welcome to the session of Reinsurer's Perspective on PV Reliability and CAT Exposures. My name is Edward Hsi. I was the former Chief Engineer and Infrastructure Business Development Director of Swiss Re. Currently, I'm working for Swiss Re as an external consultant for risk financing solutions and risk management. My background was electrical engineering, and I'm also a chartered financial analyst and a senior member of IEEE. My presentation today is organized into these 5 topics. I hope you'll find the information useful for your work. Let's start with the first simple question. Why insurance matter? As an example, when we want to buy the house, most of us would need a loan from the bank. The interest rate that we get from the bank depends on the bankability of the house as well as the credit history of ourselves. But have you ever think about the question, would you be able to get a bank loan without buying an insurance policy for the house which the bank uses collateral? Usually the answer is no. You wouldn't be able to get a bank loan unless you buy an insurance policy for your house. The same logic also applies when you want to finance your PV projects. However, the bankability story for PV projects is a little bit more complicated than the bankability question for buying a house. The 2 reasons behind this is because, number 1, the value of the collateral, that is your PV assets, actually goes down rather than goes up, as in the housing example. Secondly, the structure, how PV projects are financed, would usually prevent the bank having any recourse against the sponsors. Therefore, particularly for project finance projects, it's fair to say that bankability is the prerequisite of investability, but insurability is the prerequisite of bankability. This is why insurance matters. Now, let's take a look at what covers are desirable from banks and investors' perspective. And I hope you'll be more convinced after this slide that insurance really matters. A typical PV project is exposed to various layers of risk, as shown in this slide. The first 2 layers, green layers, are the most common cover you can get for any investment. The first layer, material damage, covers the fire, lightning, and the natural catastrophe losses such as hail and hurricane losses. The second layer, business interruption, covers your loss of income as a result of the underlying material damage. That is, it will only pay the loss of income if there has been a material damage loss. The top 4 layers are less common in the traditional market, insurance market, and for traditional investment, but very, very desirable for PV projects. They are the third layer, PV module warranty. Most PV manufacturers provide 25-year performance warranty to their client, that is you. However, the bank would usually like to see that the PV manufacturers buys insurance against their warranty liability so that they can be sure when there's a warranty claim, it will be honored, particularly in view of the huge accumulation of a PV manufacturer's product. The fourth layer is volume risk. It covers both the lack of sunshine as well as the volatility of sunshine. The volatility matters because usually a project finance company do not have very much working capital left on their account. Therefore, with a volume risk cover, such as a parametric sunshine, lack of sunshine cover, it will reduce the requirement of allocating more working capital, and therefore desirable for both the banks and the investor. The fifth layer, grid risk, is more and more relevant in today's market because the penetration of renewable energy is now reaching a threshold where curtailment is often a necessity rather than option. The sixth layer, market risk, is the most difficult one. As we move away from the FIT scheme, there's no longer guarantee on how much each kilowatt will generate for the investor or the banks. Therefore, this market risk is also desirable. This market risk cover is often desirable. Now we want to move on to an example on how Swiss Re underwrites PV warranty risk. Since 2015, Swiss Re has received many requests to provide 25-year PV module performance warranty. In order to provide such cover on a responsible basis, on a credible basis, Swiss Re started doing many stress tests on PV modules and also conducted many plant audits to the PV manufacturers. The result of this 3-year research was summarized in a book called Solar Panel Code of Practice, as shown on this slide, which is available from Swiss Re website for download free of charge. If you are interested in learning more about how Swiss Re approach this solar panel warranty insurance and how Swiss Re conducts its stress test as well as plant audit, please feel free to download it from Swiss Re website. In the Solar Panel Code of Practice book, you will see that there are 3 key improvements made. Number 1 is risk-adjusted testing. Our starting point was the IEA 2014 failure mode chart for PV modules. The way Swiss Re uses it is to decompose into 6 components. Number 1, failure mode. Number 2, failure consequences. From here, we differentiate those failure modes that create larger problems versus those that create minor problems, and assign different weights. The third component we focus on is failure time. Failure time matters because of 2 things. Number 1, time value of money. A payout at year 10 is different from the payout at year 2. It also matters on how we test the modules. The fourth component, failure cost, is important because it will determine what kind of stresses that we should apply on PV modules when doing the stress testing. The fifth component is not shown on the IEA chart explicitly, but very important for an insurer because, for example, some key component, there could be one manufacturer having 60 or even 70% market share. In that case, if that key component has a problem, then we are basically seeing a systematic accumulation of problems for all the PV modules that we insure. The sixth one is the look-ahead component. Because due to the cost cutting each year for PV modules, the BOM of PV modules are constantly evolving. For example, with thinner glasses, with thinner cells, leading to more mechanical failures. So we must incorporate this look-ahead component so that the testing can be relevant for the latest technology. The second key improvement in the solar panel code of practice is the component called user-based testing. The same testing protocol should not be applied to modules manufactured by different manufacturers because each manufacturer has its own characteristics and strong points and weak points. We should be able to incorporate the deficiencies observed during the factory audit into the testing program. The third key improvement is the structured plan audit procedure that provide the necessary feedback loop to the user-based testing. There are other risk factors that we need to consider during underwriting, such as risk accumulation, particularly in view that each policy will last for 25 years, and the sum insured will aggregate on top of each other. Secondly is systematic risk, just like the scale factor that we mentioned, having a key component supplier having over 60% market share. The third component being dynamic risk landscape. Now let's take a look at some PV reliability and cat loss examples. One of the most severe PV reliability losses was the multiple rooftop PV fires caused by a junction box defect, leading to the recall of over 300,000 PV modules manufactured over a 4-year period. From this example, you can see that a defect in material can be unnoticed for over a 4-year period, and such the accumulation of risk for insurers can be very, very high. On the natural catastrophe side, we see during the past 2 years in the US, PV hail losses in Texas, estimated loss amount 70 to 80 million US dollars. And the forest fire in California also causes a loss of around 20 million per project. In Japan, we see many typhoon losses to both floating and also stationary solar panels. The floating solar has been more and more popular recently, and their loss is also worth noting. In conclusion, number one, I hope you're convinced now that insurance matters. A PV investment can be exposed to multiple layers of risk, from material damage, to business interruption, to performance warranty, to volume risk, to grid risk, to market risk. And if you can transfer some or most of this risk to an insurance company, the bankability of your project can be very different. Secondly, it should be noted that insurance is a promise to pay. Therefore, only those insurance policy which has done their technical due diligence, such as the practice Swisher did with its solar panel code of practice, can provide credit enhancement to your project. The third conclusion is that in many countries are now having a very aggressive plan to deploy more PV modules. Therefore, it is expected the capacity requirement and risk accumulation will be very high for both the banks and the insurance companies. Thank you for your time today, and I hope you'll find the information useful for your work. Thank you.